silver is volatile. Take advantage of that volatility, make it work for you. Anyone who is able to participate in this market will very likely experience this as the best silver bull market they will ever experience.
Please join us for our next live stream Sunday, May 8th at 9 p.m. Eastern. We'll go over current events, past guests, and of course, gold and silver news. Once again, our next live stream will be Sunday, May 8th, 9 p.m. Eastern. See you then. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. Peter Krauth, author of The Great Silver Bull, Crush Inflation and Profit as the Dollar Dies, joins us today. Peter is a former portfolio advisor and a 20-year veteran of the resource market with special expertise in precious metals, mining, and energy stocks. He is the editor of 2 newsletters to help investors profit from metal market opportunities. And Peter has also contributed numerous articles to Kidco, BNN, Bloomberg, Financial Post, Seeking Alpha, Streetwise Reports, and Investing.com, among others. And he holds a Master's of Business Administration from McGill University. And we're delighted to have Peter join us today as a first-time guest. It's time to saddle up and silver up for Peter Krauth. Peter, welcome to SBTV. How are you doing?
I'm doing well. Thanks for having me, Patrick. I look forward to our chat today.
Very glad to finally have a chance to talk with you, Peter. It's our first time. Peter, silver, the history of silver, the silver markets, including miners. In a recent article in Seeking Alpha titled An Inflection Point for Silver, you mentioned how the Fed cannot stop inflation. Rapidly raising rates could slow economic growth, and the infamous zombie companies would go under. What are these things, though? What do they have to do with silver?
Well, thanks for asking, Patrick. They have a lot to do with silver. Silver, like gold, has proven itself over millennia as an inflation and a chaos hedge, a hedge against uncertainty. And what makes silver different are a couple of things. One is obviously it's less expensive than gold. That as you progress through a precious metals bull market, silver tends to outperform gold because people who have maybe come late to the party tend to look for an alternative after they've seen gold run. Silver tends to be that alternative. And as far as the first points you mentioned, if we look back, for example, at the 1970s, when we have, I guess, the most comparable period in terms of economics and inflation and money printing, etc. There are some parallels and there are some differences. The big difference is that debt to GDP, if we use the US, for example, was much, much lower. Debt was about 35% of GDP. Today, it's 130%. So it's nearly 4 times as much debt to national GDP. So because debt was so much lower back then, the Fed eventually had the ability to fight inflation by raising rates dramatically, up to 20%, which was done by Fed Chair Volcker. Today, I don't see that possibility. For the Fed to raise rates enough to really, truly fight inflation. If inflation right now is at 8.5%, which was the March print, Fed rates would have to be somewhere, let's say, above that. And we both know what that would do to interest payments just on the federal debt, not to mention mortgages, not to mention businesses that are leveraged. It's just, their hands really are tied. I think that if you really look at this seriously, it seems quite obvious that yes, they will raise rates, maybe even by 50 basis points at a time for over, several months. But there's no way that they're going to get rates above the inflation rate. They can hope inflation will fall. I don't believe they really want inflation to fall that much. High inflation actually helps them repay their debts more quickly and more easily. And so I think what we can expect is somewhat raised rates, nowhere near enough to fight inflation, and inflation basically continuing and staying well above interest rates, and in fact, perhaps even at some point getting somewhat out of hand. Now, I'm sorry that was a long answer, but I'm trying to tie in all these different aspects.
Yeah, no, and you made a lot of great points. I completely agree with just about all of them. Peter, your soon to be released book, The Great Silver Bull Crush Inflation and Profit as the Dollar Dies, you noted that according to the US Treasury itself, Federal Reserve notes are not redeemable in gold, silver, or any other commodity and receive no backing by anything. Now, this has been the case since 1933. The notes have no value for themselves, but for what they will buy. I gotta ask, what are we doing then? I mean, using paper and even digital money.
We are conducting a really dangerous experiment, really, is what we're doing. And we've been doing that, like you say, since 1933. It's gotten worse since, I mean, there was some sort of semblance of control, I guess, up until 71 when Nixon closed the gold window and took the dollar off of gold. But we're conducting a really dangerous experiment because if you look back through millennia of history, this has never been the case. There has not been sort of, especially a reserve currency, so to speak, backed by a precious metal. And so, yeah, I mean, it's just something very dangerous. Debt levels are crazy. They're getting crazier. And I guess in reaction to the 2008, 2009 financial crisis, I think that's when modern monetary theory really kicked in. And that's where you're really monetizing the debt. You're not taking into account any concerns about deficits and debt. And I mean, true modern monetary theory is when the Treasury and the Fed are apparently supposed to, be working in concert as one. We don't have that in an official way, but we're certainly heading towards that. And then when we got to the pandemic, the COVID pandemic, this all just sort of kicked into high gear. And I have a chart in the book actually that shows what happened to the Fed's balance sheet, and I believe it went in say about 2007 or so to 2000 maybe 12, 13. It went from about 1 trillion to 4 trillion, and then in the space of about 18 months, it went from about 4 trillion to 8 trillion. And so that was much, much faster. This whole thing is really sort of accelerating. And again, it's a very dangerous experiment. And that's why I'm such a bull on silver, gold, of course, as well. But silver is much more cheaply valued versus gold. And so I believe that silver has considerably more upside. But silver and gold have proven themselves over millennia as inflation and chaos hedges, as we said earlier. And so that's the connection back to silver. It's really something that even if someone has only just a small amount allocated of their overall financial portfolio to silver, it really makes a lot of sense, more now than ever, and especially silver because it's just so cheaply valued, especially versus gold.
Yeah, that's a great point. I was going to ask you about MMT. If I think at some point it's going to be politicized. I mean, with all the printing to cover debt, forgiveness of student loans, the talk of universal basic income stimulus, and it being straight, this is basically to buy votes. I mean, if MMT comes in, do you think it's going to be somewhat politicized?
I completely agree, and I mean, we see these kinds of things all the time. It's nonsense, but to bring something in, make it sound academic, refer to academic papers or research that justifies it, and it obviously serves, as you say, a lot of political purposes, and to it will not be difficult to sell simply because it allows governments to make bigger promises, and who's not going to want to be promised more goodies, and people, I think deep down they kind of probably realized their votes are being bought, but at some point everyone kind of says, well, you know what, everyone's going to kind of pay for this at some point. I might as well kind of get my share, and let's just go for it. So I don't think there's going to be much resistance. I really don't. One of the quotes I have in the book that talks about actually modern monetary theory, if the quote is something along the lines of, if you repeat, a lie or repeat something that's nonsense often enough, it'll become, it's easy to get people to believe it because you've just repeated it often enough.
Yeah, we see a lot of that, a lot of that going on today. But Peter, why don't we hold our legislators to account that our money should have value on its own and it should have some form of weight or measurement attached to it or to define it?
There are two parts. One is that yes, money is kind of maybe made to seem complex, and really it isn't. I talk about that also in the book. It boils down to the fact that if you think what money is, it's really a store of labor. People work, they earn money, they use that money to they put it aside, and then it's to be used in the future. But the problem is that the kind of money we have today that's not backed by something of value obviously loses value. If you look at what has happened to the US dollar since it came into use in 1913 to today, it's down by, I think it's something like 97%. And so that says it all, right? It does not preserve value. And so that's the risk, is that the money we have today doesn't preserve its purchasing power. People will count on it, or are used to counting on socking away their money if they save for the future during other more difficult times or during retirement. And the danger is that it will not have the purchasing power that they expect it to have or they feel it should have. And there is also an example in the book that shows what happens even, and today, in the US, we're at, say, 8.5% inflation. That was the March number. So even at the chart I have is at 5.4%, you lose, I believe it's 40% of your purchasing power in as little as about 6 or 7 years. So your $100 buys you $60 worth of goods in about 7 years. That's just crazy. And that's not at current inflation rates. So you can easily assume that at current inflation rates, you're losing half of your purchasing power, at least half of your purchasing power, probably within that time frame, about 7 or maybe even 6 years. It's a progressive thing, and it builds on itself. It works even faster at higher rates. Needless to say, why we don't hold politicians accountable, I think it goes back to what we were saying about MMT, and that is that people they like the goodies, they like the promises, and so having an unbacked dollar or currency allows governments to do those kinds of things, and it takes away the proper management of the currency and the limits. And so with no limits, they can print, they can promise and buy votes and hope to get back into power.
Yeah, I guess that's why in your book you call the US dollar as the world's reserve currency, which is unbacked, a failed experiment. And Peter, you also talked about in your book market shenanigans. Can you explain what happens and how it happens on exchanges such as the comics that lend to the belief that there really may be shenanigans and even price manipulation happening with precious metals?
Yeah. So, I mean, I just want to start by saying that, as far as manipulation goes with precious metals, I do believe that there is some of that goes on. I believe it's on a what we call a shorter, perhaps, time frame. It's over the longer term. I think that these things play out. The influence is quite limited, and I think that I do. An important point, I think, is that I don't want people to feel like they should stay away from something like silver or gold because they say, oh, it's a manipulated market. Um, as I say, the effects, I believe, are somewhat limited, and the longer term value ultimately plays out, exerts itself, and so it's absolutely a sector that people want to have exposure to, no matter what. Um, you know, there are always these kinds of things where there's a buck to be made. People will jump in and try to take advantage of situations. We see that actually playing out. There are court cases and all sorts of things to try to clamp down on these kinds of things again. But as I say, long term, do not let that shy you away from participating in this market. There are ways to do it. with by lowering your risk. That's something I also talk about in the book. Different things you can do to mitigate your risk in a silver investment portfolio, and these work well. Silver is volatile. Take advantage of that volatility, make it work for you. But this can and will be a very profitable bull market, and that's exactly why I call the book "The Great Silver Bull." I really think this is going to be anyone who is able to participate in this market will very likely experience this as the best silver bull market they will ever experience.
Someone who took advantage of silver market was the Hunt brothers. The Hunt brothers who knew the dollar was a failing experiment, witnessing the loss of purchasing power through inflation, decided to load up on massive amounts of physical silver. And besides buying physical, they also bought ETFs, but instead of settling for cash, the Hunt brothers, they took delivery of these ETFs or the silver on the ETFs. Peter, why don't we see more people or institutions taking delivery, physical delivery?
That's a good question. I honestly think that if there is one reason, maybe there is. My guess would be that there may be pressure. If a lot of delivery were taken, it would squeeze those markets. A lot of that may or may not be there available for delivery. If there was a large, or if there were, say, multiple large requests for delivery, I could easily see the exchange saying, we have to settle in cash. They have that way out all the time, and so I think that there is probably some pressure to mitigate that, that those kinds of requests. However, I think it was in 2020, and even through a good part of 2021, there have been outsized delivery requests from the COMEX for silver, for physical silver when contracts come to expiry. So that says a lot about that, how people are using that as much as they can to acquire the physical asset, and the pressure that it's likely putting on it. And so people really are becoming uncomfortable. They really want to have the real thing in their hands, and I think actually silver bullion, where you are, actually can serve that purpose quite well.
Yeah, yes, we can. Thanks, thanks for
No
thanks for
doubt
the
about that.
plug there. But in sticking with the Hunt brothers, they were somewhat prevented by the U.S. government in acquiring silver, and they were even investigated. And in 1988, they filed for bankruptcy, largely due to silver speculation. Now, another large silver accumulator to follow was Warren Buffett. And Buffett, he uncharacteristically surrendered his position in silver. So I want to ask, in your opinion, do you think Buffett was approached by the government the same way that the Hunt brothers were?
Well, given who Warren Buffett is, if he was approached, I would guess that it would not necessarily have been in quite the same way. However, um, I couldn't rule that out. I mean, if you look at what took place during certain years in terms of Berkshire acquiring, I think it was like 130 million ounces of silver, and then just a few years later, I believe he started acquiring in near the low of 1998, and then within about maybe 6 to 7 years, um, the first silver ETF came to be the SLV, and so you know these 130 million ounces were acquired. They were sitting in London, and there was pressure from the silver users in the U.S., especially industrial users, not to allow the ETF to go forward because they were concerned that there wouldn't be that would soak up a lot of supply, and yet that ETF came to fruition. It was enacted, and it was around that time or just before that that apparently Berkshire sold off their 100 or so million ounces of silver and did quite well with it. So I do talk about that in the book. There are no conclusions. Yet, if you look at the timing and how things lined up, it certainly looks like that kind of supply of silver, and then the launch of a silver ETF that had tens of millions of ounces within months jumped from maybe I believe it was 20 million to 60 million and on from there, and then eventually quite quickly reached 100 million. To get that kind of silver, you'd have to ask yourself where you could put your finger on it, and that may very well have been the source.
Peter, you are a student of the Great Depression, and during that time, we saw the stock market crash, and this is from your book as well. And today, we hear people similarly saying they expect a 30 to 40% correction or so in the stock markets. But what was it that hurt Main Street during the Great Depression? Was it that stock market crash, or was it the tightening of credit that followed?
Yeah, I mean, probably a combination, but I think it was the tightening of credit. It's unfortunate that on some level there probably was a fair bit of mismanagement, but I tend to think again, if you look back at the fact that there was already a Federal Reserve, and the fact that they do try to intervene and do try to manage is the biggest mistake in terms of all of this. You know an economy is, and especially a large economy, is an extremely complex uh, ecosystem. And so to think that even with 100 or 1,000 PhD economists that you can micromanage something like a massive economy, I think that's just complete folly. There's no good explanation. It serves lots of purposes that I'm not going to go into, but it just seems totally ludicrous that you would think you actually could manage something like that. So to be honest, before the Fed existed, there were cycles, there were business cycles, which are natural. And so you had regular cycles of economic growth. There would be speculation, there would be overinvestment, and these cycles would lead to recessions. They were often short, they were maybe a bit sharp, but all of this corrected itself. You did not need a central bank to manage it all, and it took care of itself. And so, to think that honestly, if I think back to how things played out during the Great Depression, I think that they were absolutely worsened by the fact that there was a central bank there that exacerbated the entire thing. It would have been had they not been there. It most likely would have played out as it had in the previous decades, where you had, as I say, very much shorter business cycles that corrected on their own and cleansed things, and the economy went back to itself.
Yeah, those 2 points where the stock market correction crash and then liquidity. It can remind us of John Law, France, and the Mississippi bubble. Peter, can you tell us a bit about John Law and the similarities that we see today where the markets are being propped up by a bank providing liquidity?
Yes, so that's a kind of a fun chapter to to read. I think in the book. That's why I included that in one of the chapters. And so the Mississippi bubble was where you had John Law, a Scottish economist that fled London under some questionable circumstances, ended up in France. The King of France had died. His son, who was a young boy, was now the new ruler. But because he was so young, someone was basically managing things for him. And John Law shows up, and the problem at the time was that when the king had died, he had spent like crazy to build palaces across the country, putting his country into massive debt. And they could simply not afford to manage even the interest anymore on the debt, the national debt. And so they were essentially bankrupt. John Law said, I have an idea. Why don't we create a central bank? And so they created a central bank, um, convinced people that They could deposit their gold and silver. We would issue paper notes, and it caught on, and it caught on for a while. And then he created the Mississippi Company, which was kind of a parallel to the what the East Indies Company that I guess more of Northern Europe was enriching itself on and trading with the East. And so the idea of the Mississippi Company was which owned land, Louisiana, et cetera, in the southern U.S. He kind of sold this as a way for people to invest in it and take advantage and kind of do hopefully as well as some of the rest of Europe was doing with the East Indies Company. And that was all, a Ponzi scheme as well. And so as those shares, people kind of got wind eventually that really there was nothing going on in the Mississippi. In fact, it had a charter that it gave it exclusive rights to trade with the Louisiana region, and so people could invest in the Mississippi Company, and we're hoping that their shares would multiply when they would sell off. He would issue more banknotes. People would take those banknotes, buy more shares in the Mississippi Company, and eventually the whole thing became a flop. People started to realize that they were issuing more notes than they had gold and silver to back. So there was a run on the bank. The entire thing collapsed. He fled, under, again, very, questionable circumstances. There were protests and all sorts of things in the streets. He ended up eventually in Venice and died in Venice. And so, when you look at what he did, and this goes back to the 1700s, you see that really we haven't learned anything, or we have, but the powers that be don't care. It serves their purposes to have central banks that print unbacked currency, and we're just repeating all of it. It's just sad, and that's why I think it is useful to be a student of history. That's why I include that in the book. People can realize that we've been here before. Here's how it played out. The lesson from that, however, is that anyone who did hold on, did not necessarily deposit their gold and silver at that central bank of France, held on to their gold and silver. When the whole thing blew up, they made out very well. They were not affected by this. In fact, gold and silver quickly returned to the main currency in France right after. And so, as I say, they were protected. They had their hedge. They did well, and that's really the lesson to take from this: is that we're building ourselves up to very much that same kind of situation. Having gold, having silver is the answer to this. It really is.
Yeah, in your book, you also mentioned how gold, silver, and commodities they sense things like inflation. How do they sense inflation, and how should you and I sense inflation?
Yes, so absolutely, they sense inflation. They there's no. It's not by accident that if you look at what's happened since, especially since sort of mid 2020, when huge stimulus programs came into play after the pandemic hit, and money supply went nuts. In the last 20 years, the global money supply is up by 5 times. In about 18 months after the COVID pandemic, 25% of all US dollars in circulation were created. So, of all US dollars ever in circulation were created in just 18 months. So, it's not an accident that commodities that are priced in dollars, that's still the case, at least for now, commodities, gold, silver, and other commodities priced in dollars have to rise. If you're going to increase the availability and the quantity of something that is not backed by anything, and increase that quantity dramatically, quickly, it's obvious that every dollar, the moment you have that many more dollars circulating, that every dollar is worth less because it's competing with every other dollar. And yet you're not dramatically increasing the quantities of the commodities that they buy. And so it's natural, it's going to take simply more of those dollars to buy the same quantity as it did previously of that same commodity. And so they're natural hedges. That's why I call them natural hedges, and that's why we have seen commodities dramatically increase in price. I mean, one of the first big ones people will probably remember was, I believe it was early last year, 2021. Lumber went crazy, up something like 250%. Oil's been shining dramatically. We've seen uranium pick up. So it's not just gold and silver. Commodities across the board are doing well. And so the hard assets really are the place to be when you have dramatic rises in inflation.
Peter, precious metals, despite the price action, they are still in a bull market right now. But all bull markets, they do eventually peak and they do end. How can gold and silver holders know when precious metals have peaked?
So actually, in my last chapter in the book, I talk about peak silver indicators. And one of them is FOMO, which is fear of missing out. And so people will flock to something like silver as they did in 1979, 1980. And I do mention, I give anecdotes when you had people lining up for blocks, and this was in January, remember? And so in the northern hemisphere, it's quite cold, and people still were willing to line up for blocks for hours and hours at a time to get their hands on a few ounces of silver because they saw what was happening to the silver price. That's an indicator that you're near the end when you see that kind of behavior. People basically throwing themselves at that particular asset. Another one is the gold silver ratio. This is a very, kind of classic one for this industry. If you look at what happened in 1980, when the ratio bottomed, it bottomed right around 15, meaning it took 15 ounces of silver to buy 1 ounce of gold. That meant very expensive silver relative to gold. And so when silver is that expensive relative to gold, you should be looking for a potential time to exit. Silver was back down to 30 ounces of silver to 1 ounce of gold in 2011 when silver peaked at $50. That again was a clear indicator of at least a medium-term peak because obviously it backed off and we're at about half that level today. There are a couple of other ratios that I find interesting. There's the Dow to silver ratio, where you divide the Dow by the price of silver, and it tells you how many ounces of silver to buy the Dow. That actually played out in the 1970s in two long waves, the first half and then the second half of the 70s. The ratio dropped dramatically, rose a little bit, and then dropped again dramatically a second time. And that meant silver became expensive relative to the Dow. Very cheap relative to the Dow. And so silver was highly priced compared to stocks. Again, another indicator that you may want to start looking at selling. And the last one is silver real estate ratio, where if you look at the average housing prices, you can do this in any country with any currency. But the example I have is the U.S. And if you look at in again the 70s and then 2000 and then back to currently, so in the 70s, it took, I believe, it was about as little as 1,500 ounces of silver to buy your average home. Then it went to over 20,000 ounces of silver in around 2000 when silver was $4 an ounce and very cheap. Currently, we're at about, I think it's around 18,000 ounces of silver to buy your average home. And so, none of these things are certainty. You wouldn't want to use a single indicator, but if you use multiple indicators and they're all sort of trending the same way and telling you, look, silver looks quite expensive or overpriced, overvalued compared to all of these other assets, financial assets and physical assets, then it's probably time again to look at perhaps selling. And you can do that. You don't have to do it all at once. You can sell in tranches, which is another way that I talk about how to buy silver and silver stocks. But you can sell in tranches. You can sell 25% at a time, 30, 35, 33% at a time. Sell your asset off in chunks as you kind of watch things play out. And so you're not necessarily all or nothing and, making an entire bet one way or the other.
Yeah, all this info and more is in your book there. Peter, speaking of FOMO, it's an emotion to be observed rather than statistical data that can be anticipated. When was the last time FOMO was observed in a precious metals bull market, and what was it like? Do you recall?
Well, yeah, I mean, I'm going to say it would be the most obvious example to me in silver, at least, was last year in late January when we had the silver squeeze. And so that was precipitated by the Reddit phenomenon where you had AMC and there was another stock, I forget exactly the name right now, but that were both uh, in this Reddit forum. People were encouraged to buy this stock that was being heavily shorted by hedge funds. And so that worked dramatically well. It was very impressive and in terms of how that played out. In fact, one hedge fund needed like multi-billion dollars, I believe, of bailout not to fail. And then within days, there was a call for squeezing silver because these participants felt that silver was being shorted, unfairly shorted, and so they said buy the SLV ETF to squeeze the shorts on silver. So if people bought sufficient silver, it would squeeze out the shorting in the futures market, and so that worked actually very well, at least for a short time. Silver went from, I believe, it was about $24, $25 to as much as $29. But in my newsletter, where I research and write about silver investments, silver stocks, etc. I told subscribers, I said, this is great, but do not expect it to last. It's not a fundamental change that's driving these price increases, and so do not be surprised if this backs off and backs off quite quickly. And it ended up that was how it kind of played out. But people seeing all of this and this dramatic sort of social media a push to buy silver and get involved in it was a clear case, in my opinion, of FOMO, fear of missing out. People jumped in. I can give you a couple of sort of other anecdotes of what took place at the time. One is that silver stocks, many of them, even the larger ones, saw their volumes rise by a multiple of 6, 7, 8 times. It was just dramatic buying that took place in silver stocks. And those shot up. Many of them, were up 50%, 100% for a matter of days. And then again, eventually sort of, backed off and went back to, prior levels. The second sort of anecdote of what happened was that people flocked to buy physical silver. I mean, physical silver dealers were swamped. Many who have been in the business for decades have never ever experienced anything like it. Premiums jumped dramatically. They doubled, tripled from anywhere from maybe 12% or 15% to 45, 50, 60, 70% almost overnight. That last sort of weekend in January, many dealers had to completely shut down because they were overwhelmed. They were completely sold out. Delays of delivery went from 2 to 3 days to as much as 2 to 3 weeks. Abnormal. And in fact, we're still actually feeling the effect of that because premiums on physical silver today, small coins, bullion coins, are still, at least in many cases, double what they normally are. So the interesting effect is that I think this whole social media, event drove a lot of people that did not necessarily follow silver to wake up to the silver reality and opportunity, and decided to participate. And I think that it's introduced silver as a very attractive investment and alternative to a new younger generation. And I think that that bodes well for the asset, and then I think that it'll help provide a very strong floor under silver prices for 5 years, 10 years at least. I think we've got a long way to go. Silver is one of the, if not, for sure, one of the hard assets that is the most undervalued right now. It would be difficult to find a better deal than to buy silver and silver stocks at this time.
Yeah, I completely agree. That was a heck of a time. I mean, the boys at Wall Street Silver, the young guys, and then you have the older guys who have been in it for a while, the Mike Maloney's, David Morgan's. You've seen them all, rally up together, and it was I think it was a really great thing. But like you said, you really had to understand that it's a long game. But
Exactly.
Peter Krauth, before we wrap up, can you tell us about your book, The Great Silver Bull, Crush Inflation and Profit as the Dollar Dies, and how listeners can follow you?
Well, sure. So the book is, at this point, depending on when this interview is released, is either available or about to be available for purchase. They can go to thegreatsilverbull.com to track news on the book. It will be available on Amazon. And so the book is essentially, I'm going to say, to simplify it, it's really in two parts. I have it split into 5 sections, but the first part is to set the stage and to explain the rationale and the case for investing in silver and why it is a proven asset, inexpensive, very much attractive in several ways, and why it has, as I say, proven itself over millennia. The second part is all about the potential of silver, looking back at what it's done before. I talk about my forecast for where I see ultimately silver going in terms of a peak price. And I justify that multiple ways where I see the silver price ultimately going. And then on the more practical side, I explain how one would go about investing in silver and silver stocks, how to build a portfolio that, at least to me, makes sense, spreading it across different sizes of companies. It certainly includes physical silver. I think that's a crucial component, even if it's a small one. You do absolutely want that. And as we mentioned before, there are ways to mitigate risk. Silver is volatile, so there are ways to mitigate risk. You can position size. You can buy into your investments in tranches. You don't necessarily have to allocate the whole amount at once. You can take profits. You can rebalance, and be there are the indicators that suggest to you when the silver price may have peaked. And so when you may be wanting to be looking at the exit door for that part of your portfolio.
That's great points. Again, a lot of times people they ask, when do I exit? When do I exit silver? And I'm like, don't ask me because I'm hanging on to mine. But Peter Krauth, we thank you for your time and we wish you great success on a fascinating and informative book. And I hope we can do this again soon.
Well, Patrick, pleasure was mine, and I certainly look forward to it. And it's been a lot of fun. And yeah, I mean, everything we talked about is in the book. I've really tried to make it something that was both entertaining and easy enough to read. It really is meant for anyone and everyone. It's not. I don't think it's written in a way that is too technical, and it's going to be easy enough for most average investors to read and understand, and to appreciate the dramatic opportunity that they have ahead in silver.
Yeah, completely agree. It is an easy read. It's a quick read. It's a quick read. Great book. Great book. Peter, again, I hope we can do this again soon, and we wish you all the best.
Thanks again, Patrick.
That was Peter Krauth sharing his views on silver and the reasons to own it now. For more info on Peter, please visit www.thegreatsilverbull.com. If you like this video, please give it a thumbs up, subscribe, and share to let the algos know you want to see more of our content. Audio-only versions of this interview can be found on iTunes and Spotify.